So now we're going to shift gears a bit and head into the global market, and we want to kick off with the OPEC data that just recently came out. And one of the things that we just wanted to reiterate when we look at, and why OPEC is important, as well as when we talk about Asia at this point in time, you have Chevron, which is scheduled to carry out multi-unit maintenance at its Richmond refiner in San Francisco Bay, which should last for about a month. And then you have Phillips 66 and PBF Energy already conducting upkeep at diesel and jet fuel making facilities in California. So when you look at the West Coast, there's going to be a fairly sizable drop and shortfall due to maintenance. And again, they're going to have to import some of these products. And that's where we should see some of this flow increasing as we come from Asia into the West Coast or PADD 5. Now, when we look at OPEC Plus in terms of the gains in May, 13 members pumped about 28.62 million barrels in May, which is down 180,000 from April, including the losses in Nigeria and Libya. But remember, when we look at West Africa, there's still a huge, sizable amount of floating storage in the West African continent, like in that area. So there's really no impetus, as we've been talking about, for them to increase production without clearing what is there as the competition increases for Russian barrels. Because as we've seen, India, and we'll talk about that more in a minute, India and China have continued to increase and purchase more and more Russian barrels, also putting more crude on the water and spiking that crude oil in transit. But when you look at those quotas, it's all going to be a matter of who is producing what and where, and why are they producing what they're producing, and what are the knock-on impacts. The shift to Asia, this just shows just how that has continued. Close to half of Russia's seaborne crude now goes to Asia. We expect that to remain the case, if not trying to actually increase it. There's obviously a limitation on infrastructure by pipe, and then the rest will go by boat. The question will then come as that 6 months expires. How much will they be able to do given the restrictions on insurance and availability of both euro and dollars to continue to finance some of these movements? So again, that's where we're going to have to watch and see what those shifts continue to be. Now, OPEC put out its June statements, and here's where we look at world oil demand. You can see that they took down Q2 by about 250,000 barrels a day. That to about 98.4, where Q3 they do have that increase back to 100. One of the things that we've been talking about is we don't expect to get to that 100, so we do expect Q3 and Q4 to get additional write-downs, and this is just driven based on the headwinds that we're seeing in terms of demand on the diesel front, and again, not to say storage, this is just the demand front. In terms of where gasoline is flowing and how it's flowing in diesel, we are seeing that step down, but it's important to appreciate that we're not seeing the step down in terms of this huge drop in demand. It's just we're not seeing the seasonal jump up, and that's what's keeping us a bit lower versus where we were in Q2, because normally you see that step up in Q2 into Q3, and then some of that staying through Q4, and we just don't see some of that demand, which again is going to keep us a bit muted. Now, when we start looking at the OPEC production, so Libya has a lot of issues right now. Their production has fallen to about 100,000 barrels a day. We'll talk more about that on the FSC show, but it's important to look at where things are at the moment, where the movements remain muted. When you look at Nigeria in 2020, they're at 1.5. Right now, they reported about 1.37. And then when you look at Angola, you can see that drop. But it's a matter of what is selling, and they're still seeing reduced selling versus 2020. So there's no drive for them to increase production. There is a drive now, as we talked about in segment 1, of them to increase production of specific grades based on the premiums they're yielding, but that's where we're continuing to see some of those impacts. Kuwait had a small step up, Saudi Arabia, UAE, but again, the biggest drops remain in Libya and West Africa, and a lot of that, Libya is obviously something very specific, which is driving Europe into the market, and they're finally starting to pick up a bit more of those West African cargoes, so we're going to want to pay attention to what is happening in floating storage in the Middle East and in West Africa, because we should start to see those come down. If we don't, we expect to see some additional OSP cuts and some of that, the spreads tightening up just a bit. Crude oil in the water came down a touch, but still remains obviously below 2020 levels, but still remains at all-time, those seasonally adjusted highs. We expect that to be the case just because, again, miles per ton are going up. The flows from Russia into Asia are increasing, putting more crude on the water. Floating storage is still very elevated, and now you have more crude in transit. As you can see here, crude in transit came down, but as crude in transit came down, floating storage went up. Again, this is just going to be that back and forth in terms of where is it? Is it currently in motion? Is it currently sitting there? So as we've been saying, we expect crude oil in transit to stay and create that really that chevron pattern and just go sideways, but not really making new highs or new lows, just staying within that band as we go into the end of the summer. And then we expect to see that increase along those seasonal lines as we go into the end of the year. As we look at floating storage, again, that increase, we expect it, if you look at 2021 and 2016, how it kind of dips down, it's something similar where we expect floating storage to stay elevated, and that's going to keep us fairly, obviously below 2020 levels, but still setting those new records above where we were last year and obviously in 2016. And some of the key interesting pieces, so China's starting to turn things back on, but there's still a little bit of that lag. Oil demand fell 8.3% to 12.45 million barrels a day in May, according to the data. And it's really just because May normally sees an increase as we go into May, June, July, but because of lockdowns, because of excess inventories, they're still fairly low versus year over year. It's obviously an increase over April, as it should be on a seasonal level, on all lockdowns winding down, and then the year to date is still 1.62% below normal, and we expect that to remain the case as we go through June. Now, when we look at Asian floating storage, some of these cargoes are showing up. And because of that reduced demand in general, you're seeing more of it remain offshore. And we do expect it to hold these levels, which will, again, take it above where we were in 2021, but obviously below where we were in 2020. West Africa crude floating storage came down. We do expect it to come down a bit more. We have Europe buying a bit more cargoes, which should bring this down. The question is going to be how quickly do they clear? And this could be a timing delay because Asia is buying, but again, not at what is normal because they're buying more Russian crudes, Russia, Iranian, Venezuelan, which again is keeping some of these cargoes stacked up offshore, but Europe is starting to purchase a bit more. China's supertanker crude imports are starting to increase. We expect this to go back up based on what we're seeing. The new numbers will be in the Friday show, the FSC show, because that's typically when it gets posted, but we do expect that to increase. Nothing crazy, but essentially above where we were in 2019, but you can see that it'll still be fairly in that range, just at a bit of a higher side. And here's where we look at Asian refineries. You can see that teapots have come back into the average. We don't see that really increasing at this point in time, just because they do have a lot of capacity. They do have a lot storage. They still have a bit of that weaker demand that we've talked about. And the SOEs continue to operate at about 75% utilization rates, so we don't see that accelerating much above 65 in the near term. U.S. product exports, you can see finished gasoline dropped 31,000 barrels a day, still well above the 5-year average. We expect that to be strong. Distillate increased 178,000 barrels a day. We do expect that to drop a bit, but still remain above the 5-year. Propane, again, big increase of 425,000 barrels a day. That's going to stay strong as well. And then we had that bounce, as we talked about, in crude oil exports from 2.2 to 3.7. We just expect that to continue to be the case. And with, again, that 4-week rolling average being 3.5, 3.6 million barrels a day that we've talked about, there has been a little bit of a slowdown in exports to Europe. Still very high, but just last month was very, very high, three-year highs. So again, they're still elevated, just not what they were last month, but still very strong going into Europe. Now, the impetus for Europe to buy more is going to remain there just because Libya is now having their issues, and they're going to look to get those grades, which is why West Africa should clear a bit faster, and we will see a bit of a pickup in European cargoes purchase, but that's more of a next month event. Gasoline exports falling back within that normal. Again, we expect this to remain above the 5-year average as more of this flows into Latin America and as PADD 3 tries to manage storage, because the storage levels are the problem in PADD 1 in the East Coast, not so much PADD 3. So they're going to try to see what can we put onto a Jones Act vessel, what can we get onto Colonial Pipeline, and then what do we kick out into the global market. Distillate exports, should stay around the 5-year average. Again, the market remains robust, especially into Europe. The ARB is open again, and that's where we should see some of this movement go into Europe, which will keep us slightly above that 5-year average. The ethane exports, again, came down a bit. We do expect to see ethane exports remain robust. We did get Olin said that they will be shuttering one of their facilities in Freeport as well as in Brazil, and reducing utilization rates at one of their ethylene facilities. So again, that's going to put more ethane in the market, which will bring prices down a bit, but that will help support exports and keep them elevated. So then when we look at crude oil exports, here you can see the spike, but as we said, it's more important to look at this streamlined. 4-week rolling average, 3.57 million barrels, 3.6 is kind of where we're living at this point in time. Crude imports from the Europe imports from the U.S. in June dropped to 1.27 million barrels a day, but May was a 3-year high. So again, still elevated, still staying strong, and we do expect to see that creep up just a bit, but a bigger increase in July. Propane, propylene exports, again, record, against the seasonal norm. We expect that to remain the case. Here's when we start looking at the different pieces. So the spread between Dubai and dated Brent is over $12.10. So again, that should continue to incentivize a bit more of that Middle Eastern crude to get moved into the market, and we want to see what it's doing at this point. Singapore margins remain very strong. We don't see that changing, just given where crudes are. But middle distillate is going to remain the favorite cut, which is why hydrocracking, that purple line, remains the strongest, because you're going to make the most middle distillate. FCC, middle distillate. Hydroskimming does more light disty, and that's the lowest. So again, that middle distillate continues to be the biggest driver when we're looking at margin. And here, just breaking that out, you get an idea of just how high that margin really is. Now, when we look at what has been set up for, here you can see that flows are increasing. A lot of that is driven by Russia. We expect that to come, about another 300,000 barrels get added. We do expect Libya to hold at that 600,000 barrels a day or so, because even though they're not getting new oil, there still is stuff that is in the there still is some of that amount that remains in storage, which again, they'll be able to kind of maintain some of those underlying flows in the near term while everything else stays fairly fixed. Then when you look out into July, you've seen Nigeria, Angola, small increases. We expect that to remain the case as there's some additional premiums. Just some examples: Chevron offered 1 million USAN with a gravity of 29, sulfur of 0.27 at a premium to dated Brent of $4.45. West African crude differentials made substantial gains in May as European refiners sought to fill out their crude slates with that light to medium sweet blends, especially given what has happened in both Russia and Libya. They want to make sure that it's there. Distillate-rich Nigerian Forcados rose $2.98 against dated Brent to $4.35 and climbed again to $6.90 above dated Brent early June. So again, you're getting that walk up just like Agena. You're getting it here as well. Heavy sweet Angolan grades were boosted by strong low sulfur vacuum gas oil and low sulfur fuel oil values for bunker fuel and refinery feedstocks. Again, all of that is going to continue to be the case. Angola's Girasol and Gambinda premiums both increased by more than $3.30. Again, all of that continuing to be the case. While Fortes had a lower price, flows from the U.S. Gulf to Europe are expected to drop. Trafi bid Fortes down at dated Brent at $4.10, down 10 cents, $4.10, which is down 10 cents from $4.20. And again, you're seeing some of the different pieces. BP also is sitting there at $8 versus but withdrew their bid for $8.40. So again, starting to see some of that compression in some areas, premiums in others, and we're going to continue to see that flow play out. Genscape is showing that there was a build. We now have oil in Europe at 2022 highs. Now, again, this is coming back to demand, coming back to some of the timing delay in terms of what is coming off. So we did get floating storage come down in Europe. Obviously, that meant that crude stocks increased. So we're continuing to see some of this back and forth. And we do expect to see that movement go up as demand continues to slow when we're looking at refined products. But you have to talk about which one. So gasoline had a small drop in storage of 12,000. But then when you look at gas oil, another drop of 38, with fuel oil seeing a big increase, as we talked about on the FSC show on Friday. But now let's look at the specifics. Gas oil continues to be at a very dire level when you look at what the normal piece, where it's at a seasonally adjusted near all-time low. We do expect it to make a new all-time low, which again is going to attract more flow through. Fuel oil, we do expect some of that recracking, but also that kick out into Asia as Asia essentially flips and tries to deal with and manage with rising middle distillate, ultra low sulfur, very low sulfur diesel, which will pull in more fuel oil. While gasoline, there's going to be managed as more gets imported. And when we look at why, well, obviously 2020 was a record year. But when you look at it, it's below 2020 levels, but above every other year, which is why we expect more gasoline imports to come into the U.S. as storage still remains at elevated levels. And then as you look at fuel oil creeping back up, and in order to try to manage this, we do expect some of that recracking as well as being sold into the international market. When we look at Singapore, light distillate had a small drop. Middle distillate had another small drop, but when we're going to talk about why that's so important, because that continues to fall while fuel stocks continue, resid continues to build. In general, overall, stocks in Singapore are fairly normal, but that we have to discuss on why. Because when you look at light distillate, it just dipped below 2020 levels. So light distillate is essentially at all-time highs. But while light distillate is at all-time highs, middle distillate is at all-time lows. So when you average it out, it's normal, but when you break it into its pieces, that's what's driving that middle distillate crack. That diesel crack is going to remain strong. Light distillate gasoline is going to be a bit weaker, and we expect that to continue to be the case as residual fuel continues to creep up, and eventually residual fuel will displace that middle distillate as countries yield to price and those subsidies expire. When we look at what happened in Fujairah, products dropped by about 2.244 million barrels, and a lot of that was driven by light and heavy resid. Light distillate dropped 313,000 barrels, down from last week's record high of the year. So light distillate made a 2022 record high, again, still fairly normal. And moving forward, fundamentals are still fairly stable. Supplies are fairly low in PADD 1, but elsewhere they're elevated, and we do expect to see some of this competition, with a lot of it actually starting to go more into the Atlantic basin between Latin America as well as the U.S. Middle distillate diesel jet fuel rose 336,000 barrels. Small rise, but again, we're still in a very, very bullish spot. Gas oil market has been outpacing that of crude oil, with pushing cracks of distillate to fresh new all-time highs. And again, that's going to continue to incentivize more production. Heavy resid fell 2.267 million barrels. Delivered marine fuel oil bunker premiums are still there, but we do expect to see some fairly tight product in some spots. loose in others as we see more of these different pressure points. And the reason why is because we continue to see a slowdown in global trade and global shipping, which is why we do expect more heavy disti and resid to go into the power gen situation. Brent time spreads continues to be strong. Here, again, this is going to be a fairly elevated piece, and it's going to keep some of that premium when we look at some of the later parts and belly of the curve, which is where we like in terms of December 23 and December 24. North Sea crude, floating storage dropped to the lows. That's not surprising given where some of the flows are. Europe had seen some builds on land, some of the drop in floating storage. And then when you look at Middle East, this is where we continue to see those builds going up on the floating storage side. The concern is going to be where does it go next? And if it continues to creep up, we do expect to see some sort of discounts come through. I think that's going to be very important when we look at the different pressure points. And again, that's where I think you're going to see some of those underlying areas where we'll see, do they start giving free, cheaper shipping, free floating storage? Because this is going to be a matter of, well, if the market is tight, why isn't this clearing? And it could be, again, a function of price or type of product demanded. And this is going to be, I think, indicative of where OSP is going into the end of the summer, as well as are they doing it on purpose because they want to make sure there's more available for their summer burn. They have been increasing the usage of natural gas, but again, they still use a decent amount of fuel oil and diesel for their production. Now, when we look at some of the demand levels on Europe, you can see that floating storage still remains fairly stable. It's going to be a matter of what goes into onshore, what stays offshore. We do expect this to remain fairly flat at the lower end as there is more than enough room onshore, and that's going to keep some of those flows going from offshore to onshore. So that's what we have for you today. If you have any questions, please let us know. You can reach us on the comments section or on or on Twitter. And we hope you have a great day and a great week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.